We've all heard this many times. If you want to make money in equities, buy undervalued stocks and wait for market to discover them. Once this happens, you make bumper returns. Now that's how value investing works. Now this investing style has captivated investors for over a century, from legends like Benjamin Graham to Warren Buffett. Now conceptually, it may look simple, but finding companies that are ignored by markets is tough. To find such companies, investors follow quarterly results, attend conference calls, track news, and study competitors. On the other hand, we have factor funds such as Nifty 50 Value 20 and Nifty 200 Value 30. These funds use valuation parameters like price to earnings, price to book, etc. to find undervalued companies. But can you really find value stocks by using such valuation parameters? Will Warren Buffett approve of such funds? Well, we will find an answer to this in today's video. Hello and welcome to ET Money's YouTube channel. We have recently made detailed videos on momentum and quality factors, and if you haven't watched them, I strongly recommend you do so. Both videos are packed with data and interesting insights. Their links are in the description below. Now this video is part of the same series. Today, we will analyze factor funds based on value investing principles. First, we will examine the parameters used to construct value indices. Then, we will analyze the performance of these indices and compare them with their benchmarks. Lastly, we will discuss if you can successfully practice value investing using such factor funds. Now, this video contains a lot of data and important takeaways that you can use in your investment strategy. I recommend that you watch it until the end. Alright, let's first look at what goes into making of value indices. Before we look at the construct of value indices, there is one thing I would like to highlight. For this analysis, we looked at only pure value indices from NSE and did not consider multi-factor indices that use value as just one of the factors. Now with this because pure value indices will give us a better idea of whether this strategy works. Now, we shortlisted 3 indices: Nifty 50 Value 20, Nifty 200 Value 30 and Nifty 500 Value 50. The names of these indices give you some idea about them. For example, the Nifty 50 Value 20 index picks 20 value stocks from Nifty 50. Similarly, the other 2 indices pick 30 and 50 value stocks from Nifty 200 and Nifty 500 respectively. Now the criteria for choosing stocks are similar for Nifty 200 Value 30 and Nifty 500 Value 50. However, the parameters used for stock selection in case of Nifty 50 Value 20 are slightly different. Okay, let's first look at how stocks are selected for the Nifty 50 Value 20 index. Making a factor index involves 4 critical steps. First is the selection of investment universe. Second is shortlisting of stocks. Third is deciding the weight of selected stocks in the index. And finally, the index makers, in this case NSE indices, have to decide how frequently they will review and rebalance the index. So, for Nifty 50 Value 20, the universe is Nifty 50. For the second step, a score is usually assigned to each stock based on financial metrics. Companies are selected based on the score. Now, in the case of Nifty 50 Value 20, the index scores each stock on 4 metrics: return on capital employed or ROCE, dividend yield, price to book and price to earnings ratio. Now we will not get into technicals here. To give you a context, dividend yield, price to book and price to earning ratios are popular metrics for selecting value stocks. A company with a low PE or PB and high dividend yield is considered a value pick. Return on capital employed, on the other hand, is a popular metric for selecting quality stocks. It shows how efficiently a company is using its capital to generate profits. So this is not a hardcore parameter used to find value stocks. Therefore, we believe using it to shortlist stocks does not make this index a pure value index. In fact, it's more like a quality plus value index. Anyways, let's continue discussing how NSE indices select stocks for this index. In the selection criteria, ROCE has a 40% weight, dividend yield 10%, price to book has a 20% weight and price to earnings 30%. Now based on this, a consolidated score is calculated for each stock. Then 20 stocks with the highest scores are selected for the index. The third step now is to assign weight to each stock. This is done based on each stock's free float market cap. So, the larger a stock's free float market cap, the more weight it will have in the portfolio. However, the maximum weight to any stock does not exceed 15%. This is done to avoid concentration. Now comes the last critical question: how frequently the index should be reviewed and rebalanced? Now, Nifty 50 Value 20 is rebalanced every quarter. Among the top 10 holdings at present, Infosys has the highest allocation at 14.9% as it has the highest free float market cap. ICICI Bank and ITC are next with 14.49% and 11.32% allocation respectively. We will now quickly look at the stock selection process for the other two indices. Most of the process is same, so I'm going to highlight only the important parts. You can guess the universe based on the names of the two indices. It's Nifty 200 and Nifty 500. They also use 4 metrics to make stock selections. These include earnings to price, book value to price, sales to price, and the company's dividend yield. Now in this case, the 3 parameters are the same. However, instead of using ROCE, index makers have used sales to price. Now this makes both these indices a better value index as all 4 ratios are traditionally used to select value stocks. Now stocks get a score based on the 4 ratios, and all 4 ratios have equal weight when the consolidated score is calculated for these stocks. Now, there is a slight difference when it comes to assigning weights to the stocks. In these two indices, a combination of free float market cap and factor score is used to decide the weight of stocks in the index. Lastly, both indices rebalance their portfolios semi-annually in June and December. Now, let's look at the top 10 holdings of these indices. NTPC has the highest allocation in both indices. Also, 9 of the top 10 holdings are the same in both indices and are mostly large cap companies. Now that's because large caps generally trade at a lower valuation than mid and small cap stocks. Apart from this, the large free float market cap of large cap stocks could also explain their higher representation in the index. Okay, let's now look at the performance of these indices. But before we proceed, if you're still watching this video, I'm sure you're finding it useful. So do subscribe to our channel if you haven't already subscribed, and do press the bell icon so you never miss a video from us. To evaluate the performance of these indices, we first looked at their trailing returns. Here, we looked at their 1, 3, 5, 7 and 10-year returns since inception. We observed that all the value indices have outperformed their parent over all the time frames. Their performance was particularly impressive in the last 5 years. Not just that, the margin of outperformance by the value indices has been much higher in the past 5 years. This was especially true for Nifty 200 Value 30 and Nifty 500 Value 50. This could mean that the recent outperformance of these indices is pulling up their long-term returns. To see if that's the case, we decided to look at the rolling returns. We calculated 7-year rolling returns of these funds between 1st January 2009 and 18th October 2024. Now the average rolling returns for Nifty 50 Value 20 stands at 15.11%. This is better than the 12.4% that Nifty 50 generated. Now we went deeper into the analysis and examined the minimum and maximum returns of the index. This gives an idea of the minimum and maximum, or the range of returns investors could have made. The Nifty 50 Value 20 index had better minimum and maximum returns than its benchmark. Its minimum returns stood at 8.37%, while the Nifty 50 stood at 5.73%. Its maximum returns are also far better than the benchmark. Now this tells us that Nifty 50 Value 20 has performed better than its parent index in both worst case and best case scenario. This is great, and that's what any investor would want from their investments. Now the average rolling returns were slightly lower than the benchmarks for the Nifty 200 Value 30 and Nifty 500 Value 50. This means on average they have underperformed the parent index. Now their maximum and minimum returns also revealed an interesting trend. The maximum return of both value indices is higher than the parent. However, the minimum returns are lower. Now what does this mean? It indicates that the two value indices could be more volatile than their parent indices. Now we also checked their yearly performance since 2010. For this, we looked at the calendar year returns of all the 3 value indices. Then we compared the return difference between them and their parent indices. Now there was an interesting finding. Of the 15-year data we looked at, Nifty 50 Value 20 performed better in 11 periods. It had lower returns than the parent only in 6 periods. The other two indices underperformed their respective benchmarks in 7 years. Nifty 200 Value 30 and Nifty 500 Value 50 have consistently performed better than the benchmarks in 2020, 2021, 2022 and 2023. Now, even though the margin of outperformance is good, this is something I had pointed out earlier. Now, this could be one reason the performance of two indices looks good when we check their trailing returns. However, they showed underperformance when we check the rolling returns. Next, let's see if these indices fall less than the parent indices when the markets are bad. For this, we looked at the quarterly returns of all three benchmarks and shortlisted quarters in which they had negative returns. Then, we mapped the performance of value indices over those periods. Let's see how Nifty 50 Value 20 fared. Since the quarter ended in June 2009, there has been 17 quarters in which Nifty 50 generated negative returns. If we map the performance of Nifty 50 Value 20 during those quarters, it did better in 11 out of 17 periods. Interestingly, in the periods it underperformed, the downside was not significantly greater than the benchmark. So from the downside perspective, Nifty 50 Value 20 has done well compared to its benchmark. Let's now take a look at the data for the Nifty 200 Value 30 index. Here, there are 18 quarters when Nifty 200 TRI delivered negative returns. Nifty 200 Value 30 fell more than the index in 13 periods. However, the degree of downside was also much higher than the benchmark. So clearly, this value index has a poor downside protection than the parent index. The same trend was visible for the Nifty 500 Value 50 index. Nifty 500 TRI delivered negative returns in 20 quarters. In 16 quarters, Nifty 500 Value 50's downside was more than the benchmark. So, both Nifty 200 Value 30 and Nifty 500 Value 50 have poor downside protection. Okay, let's summarize our findings from the analysis. Nifty 50 Value 20 has done well both in terms of returns and downside protection. This index can be a good option if you wish to invest in large cap value companies. Now, one reason for this index is good performance could be its use of ROCE while shortlisting companies. The index has allocated a 40% weight to the ROCE, which helps identify fundamentally good companies available at reasonable valuations. Nifty 200 Value 30 and Nifty 500 Value 50 have underperformed their benchmark when we check rolling returns. They are also more volatile than their parent indices. In recent years, we've seen rallies in PSU, defense, railways, and power stocks. This broad-based rally could explain why these indices have done well in the past few years. However, if we look at the long-term data of these two indices, their investment style has not fared well for the index. Simply investing in stocks available at low valuation does not appear to be a good investment strategy for these indices. A stock could be trading at a low PE because of some fundamental problems in the company. For example, let's take the case of CESC Limited. This company is part of Nifty 500 Value 50 portfolio. It trades at a PE of 17.8 and a PB of 2.2. Its market cap to sales ratio is 1.6. Now, based on these metrics, the company is trading at a good valuation. However, if we look at the company's fundamentals, we see that even though its revenue is increasing, its operating and net profit margins have decreased. The company's operating margin was 27.9% in January 2020 quarter, but it has since declined. As of June 2024 quarter, it stood at around 7.63%. Now, this shows that the company is available at a cheap valuation due to a fundamental problem with its business. So, investing solely based on low valuation does not appear to be a good idea. Now, there are a few more companies with some fundamental issues that are part of Nifty 200 Value 30 and Nifty 500 Value 50 index. Based on this, it appears that using valuation ratios along with quality metrics might be a better way to approach value investing than simply buying companies with low valuations. Warren Buffett would definitely not approve of using only such ratios to invest in stocks. And with this, we have come to the end of this video. I hope you found the analysis useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.